She thought she was helping. Instead, she triggered a 5-year countdown to financial ruin. And the worst part? She followed the rules. Every single one. Barbara is 71 years old. She lives in Ohio. She worked hard her entire life, raised her children, saved carefully, and built a modest but solid financial foundation. She owns a home she bought for $80,000 3 decades ago. Today, it's worth $400,000. She has a brokerage account filled with stocks she's held for years, reliable investments she built slowly over time through discipline and patience. She did everything right. Then her son James lost his job. He's 43, 2 kids, mortgage payments piling up, 8 months without steady income, pride slipping through his fingers like sand. Barbara looked at her savings and made the decision that millions of parents make every year. It's my money. I earned it. Of course I'm going to help my son. So she wrote him a check for $20,000.
Then she transferred some appreciated stock into his name to give him a bit more cushion. The following year, remembering something she'd heard about being allowed to give $19,000 per year without tax consequences, she gave him another $19,000. Everything was legal. Everything was within the IRS guidelines. She filed no gift tax return because she didn't need to. She owed no gift tax. She thought she was in the clear. 3 years later, Barbara fell. Fractured hip, hospital stay, complications. Rehab that didn't quite work. Her condition worsened. She needed full-time care, long-term nursing home care. Her savings, once comfortable, started draining at a rate she hadn't anticipated. Over $9,000 a month. Month after month. The money she had spent decades building vanished in a matter of months. When the savings were nearly gone, she applied for Medicaid to help cover the nursing home costs. That's when everything fell apart. The state of Ohio didn't just look at her current financial situation. They looked back. 5 full years. Every transaction, every check, every transfer, every gift. They found the $40,000 in cash she gave to James. They found the stock transfer. They calculated a penalty period. Barbara was denied Medicaid coverage for months. She was in a nursing home. She had no money left to pay privately. The funds she gave to James were gone, used for the mortgage, groceries, school expenses, braces for the kids. He couldn't return it. The IRS had told her everything was fine. Medicaid didn't care. And nobody, not her accountant, not her financial advisor, not her friends, had ever mentioned that those were two completely different systems with two completely different sets of rules. This is one of the most devastating financial traps in retirement. It punishes generosity, it punishes parents for trying to help their children, and it happens because retirees are only told half the story. Today, we're going to break down the 3 specific government rules that collide in situations like Barbara's and destroy families financially in the process. First, the annual gift tax exclusion and why it offers zero protection where it matters most. Second, the Medicaid 5-year look-back rule and how it silently overrides everything the IRS tells you. Third, the capital gains carryover trap and how giving the wrong asset can saddle your children with massive, unexpected tax bills. Then we'll walk through exactly how to help your family without destroying your own financial security in the process. This is for educational purposes only and is not tax or legal advice. Before making any financial decisions, consult a qualified tax professional and a licensed elder law attorney in your state. Now let's start with the rule that almost everyone thinks they understand. The IRS annual gift tax exclusion. In 2026, you can give $19,000 per person per year without filing a gift tax return. If you're married, you and your spouse together can give $38,000 per person per year. You can give to as many people as you want. 3 children? That's $57,000. 7 grandchildren? That's $133,000. A neighbor? A niece? A friend? It doesn't matter. As long as you stay under $19,000 per recipient per calendar year, you don't have to file Form 709. You don't pay gift tax. You don't reduce your lifetime exemption. Even if you exceed $19,000, you usually still don't owe tax. Why? Because the lifetime estate and gift tax exemption in 2026 is $15 million per person. you would have to give away more than $15 million over your entire lifetime before you'd owe a single dollar in actual gift tax. For the vast majority of retirees, that threshold is completely irrelevant, so the IRS rule is generous. Under $19,000 per year, no reporting. Over $19,000, file Form 709 to track it against your lifetime exemption. Under $15 million lifetime, no tax owed. Simple, clean, reassuring, and completely, utterly irrelevant when it comes to Medicaid. This is where the trap begins. Noir, Medicaid is not the IRS. Medicaid is a joint federal and state program that operates under an entirely different legal framework. It does not care about gift tax exclusions. It does not care about lifetime exemptions. It does not care whether you filed Form 709. When you apply for Medicaid long-term care benefits, the program that covers nursing home care, home health aid services, and extended custodial care, the state examines your financial history for the previous 60 months, 5 full years. This is called the Medicaid look-back period. Every financial transaction during that 5-year window is reviewed. Every check written, every wire transfer, every asset sold below fair market value, every gift. The IRS annual gift exclusion offers zero protection. Under Medicaid rules, none. You could give your daughter $5,000 for Christmas. You could give your grandson $2,000 for college books. You could give your son $19,000, perfectly within the IRS annual exclusion. Medicaid treats all of it the same way. If assets left your control during the 5-year look-back window, they count as transfers and they trigger penalties. Number 1. The Medicaid penalty period. Here's how the penalty is calculated. The state adds up the total amount you gave away during the 5-year look-back period. Then they divide that amount by the average daily cost of nursing home care in your state. That number is called the penalty divisor. In a state where the average daily nursing home cost is $350, a $35,000 gift equals 100 days of Medicaid ineligibility. In a state where the divisor is $400, a $40,000 gift equals 100 days of ineligibility. The math is mechanical and precise. Total gifts, daily cost, number of penalty days. You cannot argue that you didn't know. You cannot argue that the IRS said it was fine. You cannot argue that it was for a good cause. The penalty period is automatic. And here's the part that shocks families. The penalty period does not begin on the day you gave the gift. It begins when you apply for Medicaid and are otherwise eligible. That means you give money away. You spend down your remaining savings paying for care. You reach the Medicaid asset limit, typically around $2,000 in countable resources. You apply. Only then does the penalty clock start. If you have no money left and the penalty period is still running, you are in serious, potentially catastrophic trouble. This is exactly what happened to Barbara. The reality of long-term care. Long-term care is the largest unplanned expense in retirement. About 70% of people turning 65 today will need some form of long-term care during their lifetime. More than 40% will spend time in a nursing home. The median annual cost of a private nursing home room in the United States is now well over $100,000 per year. In some states, it exceeds $150,000. Medicare does not cover long-term custodial care. It covers skilled nursing care for up to 100 days after a qualifying hospital stay and only under very specific conditions. After day 100, Medicare stops. For the vast majority of retirees who need extended care, Medicaid becomes the only program that covers it. And Medicaid is the program that reviews every gift you made in the last 5 years. Now let's look at how this plays out with real people. Dorothy's Christmas gifts. Dorothy is 68 years old. She gives her daughter $5,000 every Christmas. She has done this for 4 years. $20,000 total. She never files a gift tax return because the amounts are under the annual exclusion. She assumes everything is fine with the IRS, so it must be fine with Medicaid. At 72, Dorothy has a stroke. She needs nursing home care. She applies for Medicaid. The state reviews 5 years of bank statements. They find the $20,000 in Christmas gifts spread over 4 years. All of it falls within the Medicaid look-back window. The state divides $20,000 by the penalty divisor. Dorothy is denied Medicaid for a period of months. She followed IRS rules perfectly. Medicaid didn't care. Nyan, Robert's house. Robert is 70 years old. He owns a house worth $350,000. He bought it in 1990 for $60,000. His son Michael is going through a difficult divorce and needs housing. Robert decides to deed the house to him as a gift. He's not selling it. He's helping his son. 2 years later, Robert has a health crisis. He needs nursing home care. He applies for Medicaid. The house transfer falls within the 5-year look-back. The state values the transfer at $350,000, the fair market value at the time of transfer. The penalty period calculated from that amount is severe. Robert is ineligible for Medicaid for an extended period. But that's not the only damage Robert caused. Michael now owns the house with a cost basis of $60,000. The price Robert originally paid in 1990. If Michael sells the house for $350,000, he owes capital gains tax on $290,000. At a 15% federal rate, that's $43,500 hour in tax. At 20%, it's $58,000. Plus state taxes in most states. If Robert had simply kept the house and left it to Michael at death, Michael would have received a stepped-up basis equal to the fair market value at the date of Robert's death. Michael could have sold the house the next day and owed zero capital gains tax. Robert intended to give his son security. Instead, he gave him a massive tax bill and triggered a Medicaid penalty that left himself with nothing. Yanur. Linda's stock transfer. Linda is 73 years old. She owns stock she bought years ago for $20,000. It's now worth $90,000. Her daughter is starting a small business and needs capital. Linda transfers the stock to her daughter to help. No gift tax owed. No Form 709 required. But Linda's daughter now owns that stock with a cost basis of $20,000 in Artitia, Linda's original purchase price. When the daughter sells it for $90,000 to fund the business, she owes capital gains tax on $70,000 of appreciation. At 15%, that's $10,500 basu in federal tax. At 20%, it's $14,000. If Linda had sold the stock herself in a year when she qualified for the 0% capital gains bracket, available to single filers with taxable income up to $47,025 in 2026, she could have paid Act 0 federal capital gains tax and given her daughter $90,000 in cash. Same amount, same intention, completely different tax outcome. Nanya Noal, the stepped-up basis rule. This rule is one of the most powerful wealth preservation tools in the tax code. When you die and leave appreciated assets to heirs, the cost basis resets to the fair market value on the date of your death. Buy stock for $20,000. It grows to $300,000 over your lifetime. You leave it to your child at death. Your child's basis becomes $300,000. They sell it for $300,000. Zero capital gains tax. But if you gift that stock during your lifetime, your child inherits your $20,000 basis. They sell it for $300,000. They owe tax on $280,000. At 15%, that's $42,000. At 20%, that's $156,000. That's not it. Plus state taxes. Gifting appreciated assets during life this year destroys what's decided and at the stepped-up basis benefit. Helping using IRA money. Another hidden trap. You withdraw $60,000 from your traditional IRA to give to your child. You owe ordinary income tax on that $60,000. That distribution may also push you into a higher tax bracket, make more of your Social Security taxable, trigger higher Medicare premiums 2 years later, still create a Medicaid penalty if given within 5 years you pay income tax. You trigger Medicare surcharges. You create a Medicaid issue all to fund a gift. The better approach is often to give cash from a taxable brokerage account or savings, where the withdrawal itself doesn't create a new taxable event. Action Plan. Step 1. Understand the 5-year rule. If you are 65 or older and could need long-term care within the next 5 years, be extremely cautious about making any gifts. Step 2. Avoid gifting appreciated assets. Hold them for the stepped-up basis at death whenever possible. Step 3. Consider selling in the 0% capital gains bracket. If you qualify, sell appreciated assets yourself and gift the cash proceeds. Step 4. Use direct tuition and medical payments. Payments made directly to educational institutions or healthcare providers are excluded from gift tax and may be treated differently under Medicaid rules. Step 5. Consult an elder law attorney before making large transfers, especially if you have substantial assets or are within 5 years of potential long-term care needs. Just reckon, can you get the gifts back? In most cases, no. A gift is a completed transfer. Once you give money or property to another person, you have no legal right to demand it back. If your child used the money to pay down debt, invested it, or spent it, there's nothing to return. In the Medicaid context, the state may ask that the recipient return the gifted amount to cure the transfer. If the money still exists and the child is willing and able to return it, the penalty may be reduced or eliminated. But if the money is gone, or the child refuses, or the property has been sold, the options are very limited. This is why timing matters so much. Gifts made more than 5 years before a Medicaid application are generally not counted. If you're healthy and planning to give gifts to family, doing it earlier rather than later keeps those transfers outside the look-back window by the time you might need care. But this requires planning at 60 or 65, not at 73 when a health event has already occurred. Medicaid Asset Protection Trusts. Medicaid Asset Protection Trust, MAPT, is a legal tool some families use to move assets outside of Medicaid's reach. Assets placed in a properly structured, irrevocable trust are generally not counted for Medicaid eligibility purposes. But only unless if the trust was created and funded more than 5 years before the Medicaid application. The 5-year clock on the trust runs from the date of funding, just like the look back on direct gifts. This is not a strategy you can implement after a health crisis. It requires setting it up years in advance. The villain. The villain in this story is not generosity. It's not helping your children. It's not even the IRS. The villain is the assumption that IRS rules are the only rules that apply to giving money and property to family. They're not. Medicaid operates under a completely separate framework. Capital gains tax operates separately. State estate taxes operate separately. And almost none of these rules are explained together in a single conversation before a retiree makes a decision they cannot reverse. Barbara gave her son $40,000 and some appreciated stock because she wanted to help him. She broke no IRS rule. She owed no gift tax. She filed nothing incorrectly. She is sitting in a nursing home under a Medicaid penalty because she didn't know about a 60-month look-back rule in a program she had never thought about. Dorothy gave her daughter $5,000 at Christmas for 4 years. The IRS would call it insignificant. Medicaid called it a transfer within the look-back window. Robert gave his son a house. He meant to give him security. He gave him a carryover basis that turned into a capital gains tax bill and triggered a Medicaid penalty that left Robert with nothing. These are not wealthy families gaming the system. These are ordinary retirees doing ordinary things with money they earned and saved and intended to share with people they love. The rules that penalize them are real, enforced, and almost never explained in advance. Before you give money or property to your children, make sure you understand all the systems involved, not just the IRS. Generosity is beautiful, but in retirement planning, Generosity without strategy can be devastating.